nos apresentarmos. Vejo que, entretanto, já houve muitos clientes a entrarem, muitos participantes também a entrarem. Pedia só que colocassem, por favor, o OK. Entretanto, as dúvidas que vão tendo em relação a esta apresentação, vão colocando na vossa janela de questões. Estejam à vontade, podem colocar em português e inglês, eu vou passá-las depois ao Jack e ele no final vai responder ao máximo de questões possíveis, portanto, ele não tem qualquer problema em ficar o tempo que for necessário para responder às vossas questões, portanto vão colocando à vontade, estejam totalmente à vontade para fazerem as questões que acharem pertinentes. Portanto, vamos então iniciar. Jack, we can start now, if you please.
Okay, very good. Good evening, everyone. So the talk I will be giving will basically be focusing on some of the key lessons I learned from interviewing some of the world's greatest traders. And in this particular talk, I focus on lessons coming from the interviews I did in the first two Market Wizard books, which now are almost 25 years old, or 25 years old. And even though they're that old, the lessons really are still as pertinent today as they were back then. So let me begin with the story of Michael Marcus, and you'll see why I'm picking him in a moment. So Michael basically got interested in trading when he was in college. He had a friend of a friend tell him he could double his money every 2 weeks, and Michael, being a little bit naive, kind of went along with it and discovered what he had in mind was commodity trading. So he opened a commodity account and hired this friend of a friend as an advisor, paid him like $35 a week to advise him. So when he went down to the brokerage company, and this is back in the days when they had the big commodity board and customers would stand in the gallery and watch the prices change. And as they're looking at the prices, his advisor is asking Michael what he thinks they should do. So it quickly became clear that his advisor didn't know anything. So Michael still was intrigued, and he did some trades, and he lost money basically. And then he had this one trade that his so-called advisor told him, which was the idea of buying August pork bellies and selling February pork bellies, because the spread between the two contracts was supposedly greater than the amount of money it would take to take delivery, pay for the storage, and then to redeliver on the next contract. And the idea was it was supposedly a can't lose trade. And so he put on that trade. He went out for lunch, and when he came back, he found out he had lost all the rest of his money in the account. He was basically wiped out. He later learned that you can't deliver August bellies in the next year, so which of course he didn't know. So that was his first experience in trading. And Michael was not one to give up, so he scraped together, he borrowed some more money, and he traded some more, and he lost all of that as well. So he was a bit disillusioned, but he still wouldn't give up. So his father had died when he was 15, had left him a life insurance policy. And so Michael cashed in that life insurance policy. It was only $3,000. And he started getting a little more serious. He started reading about grains. He subscribed to a grain newsletter. He became a little more informed. And in 1970, he decided he bought corn. And really more a matter of luck than skill, that year there was the corn blight, a disease that affected the corn crop. And there was great devastation of the corn crop. And the $3,000 account went to $30,000. So Michael was kind of thinking he was pretty smart at this point. And the next year, he was again going to, there was rumors that the blight had wintered over, that it was still, that the disease was still going to be active in the following crop. So Michael had the $30,000. He then went and he borrowed $20,000 from his mother and gave him $50,000. And he took the whole $50,000 and margined as much as he could, bought lots and lots of corn and wheat contracts. So he was going to make a killing on this trade. Well, one day there was an article in the Wall Street Journal that said there's more blight on the floor of the exchange than in the fields in the Midwest. And basically that day the market opened up sharply lower and within a few minutes went limit down. And Michael was basically paralyzed, and he didn't react, but it made no difference anymore because by that point that one day limit down was enough with his margin to force him out of the position, and the next morning he basically had to sell out everything. And he lost his entire $30,000, everything he made, the $3,000 he added, and on top of that he also lost $12,500 of the money his mother had loaned him. So he was way down. And the story goes on. It was not a simple process, but he just would not give up. And eventually Michael learned how to trade. The two main things he got was he basically he got the experience from being so interested in markets, and more importantly, he learned about risk management. And the two together, and he had great talent. I shouldn't leave that out. He had great talent as a trader. And so eventually he started making money, and lots of money. And he got a job at Commodities Corporation, and they gave him, as a prop trader, they gave him $30,000, and a few years later they added $100,000. That's all they gave him in allocations. About 10 years after he started, that account was worth $80 million. $80 million, and I know because I worked at Commodities Corp as well. And that was with them taking money out of the account every year. They were taking out 20 to 30% for expenses in the company. So this is, with all the massive failures he had, he ultimately went to spectacular success. So I start with this because there's 2 points here about failure. First, early failure does not necessarily imply that there's no future success. As with Michael, many of the market wizards I interviewed started off with failure, and they became very successful. Now, of course, failure will not mean you're going to be successful, but what I'm saying is it neither does it mean that you won't be successful. And the second thing is that the market wizards did not give up. Actually, most of them lost money at the beginning, but they kept on, they didn't give up. And had they given up, had Michael given up, he would never have discovered that he had this great talent. He never would have had his great success. So his success really is due to very large part to that inner resilience not to give up. Okay, so the next point I want to talk about is the idea that there is no single way. There's no single right way. I will often get emails or letters from people, and they'll say, asking me that they want to work for some sort of market wizard. Can I recommend, or is there one way they should trade? And it's really a wrong way of thinking about the markets. And to illustrate that, I'm going to give you an example of two of the different wizards I interviewed. So on the one hand, we'll start with Jim Rogers. Jim Rogers is one of some of the people I've interviewed were sort of anonymous to the world, but some were well known. And Jim, I think, has had more publicity than most. You may even have seen him he's often on TV commentating. He wears a bow tie, if that refreshes your memory. He was originally a partner of George Soros in the Quantum Fund, and he and Soros started the Quantum Fund in the 60s, and back then it continued to be an enormously successful fund. But when Rogers and Soros ran it together, it was probably the most successful hedge fund in the world. Rogers left because he didn't want to be bothered with the management. He didn't want to work for a big company, and so he left to become a private investor. And over the decades, he invested his own money very successfully. When I interviewed him, which was back in 1988, you can go back to that original interview and look at his projections of things we talked about. We talked about gold. At the time, gold had been going down for 8 years. Rogers said it would go down for another 10 at least, and he was absolutely right. Gold did not bottom until about 12 years later. he talked about the Nikkei. At the time, the Nikkei was in a wild bull market, and it was up in the mid 30,000s. And Rogers was convinced there was a bubble, and he was predicting it would go. He was predicting not just that it would go down, but it would go down to under 10,000, which seemed like a crazy, crazy type of projection. But he was absolutely right. It actually went lower than 10,000. So here's a guy who has just a great record of long-term forecasts and clearly knows what he's doing. I asked him, I know you're a fundamentalist, I asked him, but do you ever look at charts? And Roger said, well, do you mean do I look at the charts just to be able to see where the market has been? Yeah, I'll do that. But do I believe in any of this head and shoulders, mumbo jumbo? I think it's all a bunch of nonsense. It's just black magic. It's just total nonsense. And he said, I never met a rich technician. And then he pauses and says, unless you count those people who sell their services. So that's his cynical attitude about technical analysis. And he became very wealthy on fundamentals. So now keep that in mind, and let me tell you, take another trader, Marty Schwartz. Marty Schwartz was, when I interviewed him, had been on an enormously successful run, an unbelievable run, trading the S&P, which he had become a specialist at. And when I interviewed him, just to give you context, he had an average return of 25%. And sometimes people are not impressed enough with that. This is 25% per month. And he had this actually, he had his track record audited because he was thinking of managing prop money. Now that sounds like an unbelievable, impossible number, 25% per month. And those of you who are mathematically oriented will be compounding in your head and realize that, wait a minute, if that was true, then in 10 years he would have 1/4 of the US GNP. Well, the thing is that Schwartz, his father had grown up in the Depression, and he instilled in his son a great fear of things going wrong. So what Schwartz would do is he would take $400,000, enter these trading contests, and this is all documented. He would turn the $400,000 into, say, about $1 million, $1.25 million in 4 months' time, and then take the profits, put it in T-bills, start again in another contest with $400,000. And he kept on doing this over and over. So he didn't have the compounding because he kept on going back to the same $400,000. But he did have that type of return. And he only had 2 losing months in the entire 10 years. And when he tells you that, he apologizes. He says, well, he said, it wasn't my fault entirely because those were the months in which my children were born and I was distracted. So that's his performance. And so clearly here's a guy who knows what he's doing. And I asked him the same question about fundamental versus technical. And he said, I spent 10 years as a fundamental analyst on Wall Street. I lost money every year. And I got rich as a technician. So you have the complete, you couldn't have more opposite views than Rogers and Schwartz. And so who's right? Who's wrong? Well, they're both right and they're both wrong. The point is that yes, you can become very, very successful as a pure fundamentalist. You can become successful as a pure technician. You could become successful combining the two. The point is there is really no single one true path. And people who are looking for that are really looking for the wrong thing. So if it's not a single true path, what is it? What you need to be looking for is not the holy grail, not that secret to the markets which doesn't exist, but rather for the approach that fits your personality. And so when people ask me, what trading approach should I use? And particularly if it's in writing, I'm not, I kind of say, look, that's the same type of question as if you send me an email and ask me what size suit should you buy. I don't know if you're 6'6" or 5'2". How am I supposed to know what size suit you would wear? And how can I tell you what trading approach you should use? The answer is different for everybody. That's what you need to realize, that it's not a matter of finding the right approach. It's a matter of finding the right approach for you. And as I said, it's going to be different for everybody. So again, let me illustrate with two people, and I think it will make it clear. And I will take two other wizards here. So first we'll take Paul Tudor Jones, who's probably one of the more famous people I interviewed, acknowledged to be one of the great futures traders of our time. And Paul, when I asked him for the interview, he said, Jack, come to my office at 2 o'clock. And I said, Paul, I know you're a really active trader. I don't want to interfere. I don't want to get in the way. Why don't I come after the market closes? And he said, no, just come at 2. So I show up his office, and he's got this large office. And this is still back in the days where this is not electronic trading. This is trading in the pits. And he's got speaker phones to all the major floors and open lines to the floors. He's got multiple monitors across his room. He's got phones that ring occasionally, people bringing him messages. While we're doing the interview, he's shouting out orders, sell 300 December gold at the market, buy 500 December crude at the market. He's got all this action going on, watching the markets, trading in size, people bringing him messages, and he's doing the interview with me. That's the way, that's Paul's personality. He's very frenetic, very active. Sort of like if John McEnroe, a tennis player, was a trader, that's what he would look like. So that's Paul's style. Now keep that image in mind, and let me tell you about another trader, a fellow called Gil Blake, who would have been completely anonymous to the world if I hadn't interviewed him. And Gil, just to give you a sense of, Gil was his approach was he was maybe the first, I think, what's called market timer. And later on, in later years, market timing got a bad reputation because there were people who abused it. They put in orders after markets closed, and there were other abuses. But back when Gil was doing it, he was simply a technical trader. He had found patterns in the market and would switch between stocks and between mutual funds and stocks and money market funds based upon his technical signals. And the way he got into the business was he was just a financial officer for a company. One day, a colleague comes in and says, Gil, would you take a look at this for me? He knew he's a numbers guy. And he said, I've been doing this, and it seems that if I use this method and I switch my money back and forth, I can do better than just keeping my money in the stock market. And Gil says, no, that's nonsense. You couldn't this couldn't possibly work. He said, just give me that, I'll look it over. And he looked it over, and when he had time, and he went over it carefully, and he discovered that indeed it did work. But once he saw that worked, he became intrigued, and he started looking for more complicated, more intricate types of ideas and patterns, and he found things that worked much better. And what he ended up doing was becoming so enamored with the possibility of making money trading the markets, he quit his job as a financial officer. And Gil, he would spend, this is before there were PCs at the time, just the very, very beginning of PCs, but Gil was not a computer guy. And even back in that time, PCs, this was before the internet, before all the information. So he would go to the library, and on microfiche would go through mutual fund prices. He would spend weeks and weeks at a time just looking at prices on microfilm. And just think of the kind of patience and just total focus to just do that. And he developed his trading systems, and he would trade it from the bedroom of his house. He wanted no interaction with anybody. He wouldn't accept any outside money. He didn't want an office. He would not trade anybody's money except his own and a few friends and family. So that's Gil Blake. Now, you got that image. Now, I ask people, can you picture Gil Blake trading in Paul Tudor Jones' office with all the bedlam going on? Or could you picture Paul Tudor Jones sitting at a machine going through microfilm prices for weeks at a time? It just does not work. It's completely alien to both their personalities. The point, however, is that each of them found an approach that really fit who they were. And so one of the first things and one of the most important pieces of advice I can give you, give anyone in trading, is the first thing you have to discover is what works for you. For some people, it will be long-term trading. For some, it will be short. For some, it will be stocks. For some, it will be futures. For some, it will be currencies. For some, it will be technical. For some, it will be fundamental. It could be any combination of those factors and lots of variation. So that is a matter that each person needs to identify, but it is essential. You need to find the approach that fits your beliefs, fits your personality. Okay, now we come to the idea that you need to have an edge. I don't know how many of you have heard the expression, the saying, that even a poor system could make money with good money management. For any of you who have heard that expression, please forget it, because it's one of the stupidest things that has ever been said about trading. If you don't have an edge, you can't make money no matter how good your money management is. And people who think that, I would challenge them and say, if you believe that money management can save you, money management alone that is, then I would challenge you to go to a casino and try to use money management to play roulette. Now, if you were to ask 100 mathematicians, what is the best trading strategy, what's the best betting strategy I can use to play roulette, they should all give you the exact same answer. The best trading strategy, if you had, let's say, $10,000, the best strategy is take the $10,000, walk over to the table, put it on black or red, and let the wheel spin one time, and then win or lose, walk away. That's your best betting strategy. Why? Well, the odds are still against you, even with the one spin, but it's not a big disadvantage. However, the more you play, the more the odds will be against you. Because why? Because you don't have the edge. The house has the edge. So ironically, if you don't have an edge, then the best money management strategy is to bet it all at once, which of course is the exact opposite of what we think of as good money management. So you need both the edge and money management, which I'll get to in a little while about the risk side of it. Now, in order to have an edge, you need to have a method. This is not a matter, nobody I ever interviewed, when I asked them how they did it, and they would all be able to tell me some very, very specifically. If you read my books, you'll see in some cases it's laid out in great detail, and in some cases it's more, it's not something that can be spelled out that exactly, but you could still get an idea of what their methodology is, what their approach is. No one I ever interviewed said, well, I get up, I look at the quote machine, and if I think that bonds look good, I'll buy some bonds. Nobody had this type of cavalier, casual answer to what their method is. They all had some specific methodology. So if you're going to win at this game, you need to know what your methodology is, and that methodology has to have some sort of an edge. Now, the next thing we come to is hard work. Why are people so interested in trading? Many cases, people are drawn to trading. Why? Because they think it's an easy way to make a lot of money. And the irony there is that the people who do make a lot of money are excessively hard workers, almost obsessively so. And I can give you lots of examples, but I will just choose one. And it's about a trader who unfortunately died a few years ago. His name is John Bender. John Bender was a physicist who went into options trading. He was one of the best traders I had ever met. The best personal investment I ever made with anybody was with Bender. When he ran his fund, he made literally triple-digit returns. When I met Bender, I met him in a hotel he was staying in New York when he came to New York. And he came down, I forget, it was like 11 or 12 o'clock. Basically, it was the close of at night. It was the close of the Japanese trading session. Why? Because as an option trader, his primary market was Japanese options. But then he would stay awake, and he would also trade the European markets when Asia closed. And he would often also stay then and trade the US markets. Now, if you put that all together, it ends up being a 20-hour day, which is pretty insane. He did that very often for every day, every weekday, and then on the weekends he would catch up on sleep. Now, I'm not telling you that this is a way you want to live your life. These are very different things. What I'm trying to describe is how crazy some of these people are in terms of the amount of work they do. And I could give you other examples as well. But John is kind of a perfect example. And so the point to realize is the markets are not an easy way to make a lot of money. To be successful, it requires a lot of hard work. And that's important to understand. Now there's a paradox here, you know, this part about being hard work. So picture someone going to a bookstore, and I think you will agree with me that no sane person that you know would ever think of walking into a big bookstore, going to the medical book section, finding a book on brain surgery, and believing that they could read it over the weekend and Monday morning go in and perform successful brain surgery. Again, I said no sane person, and I'm sure you all would agree that no sane person would think that way. But now consider this, and here's the paradox. How many people do you know who would think nothing of going into the bookstore, going to the financial book section, finding a book like with a title something like How I Made $1 Million in the Market Last Year, reading it over the weekend, and then believing with nothing more than that they can go in Monday morning and beat the professionals at their own game in trading? Lots of people. So that's the paradox. Why in one case would people have to be insane to think that they can become experts by reading a book over the weekend? And in the other case, it's something that people commonly do. And this is a paradox which, in my opinion, has a very satisfactory answer. And do you know what the answer is? The answer is that trading may well be the only profession in the world where the rank amateur, the complete novice who knows absolutely nothing, has a 50-50 chance of winning in the beginning. Why? Because there's only two things a person can do. You could buy or you can sell. That's it. So even if you have no idea what you're doing, by pure luck, some people are going to be successful in the beginning simply because they're in the right market. I mean, how many people thought they were geniuses because they were buying stocks in 1999? So it's not a matter of being smart, it's just a matter of being lucky. But you can't be lucky in other professions. In trading, you can be lucky for a while. So take the example of brain surgery. If you've never had the training and experience, you just can't go and do it. The chances of someone who has never played the violin picking up a violin and playing first solo for the New York Philharmonic is zero. But when it comes to trading, the chances of somebody equally inept trading and making money in the beginning are close to 50-50. So, however, the point to understand is that if they continue, it's just a matter of time before they lose their money. In reality, trading is no different than anything else. You still need all the hard work and all the expertise to be successful over the long run. But the fact that people can be successful even for a while by luck fools a lot of people. It beguiles people to believe that trading is a lot easier than it really is. So now we come to the idea that good trading should be effortless. And if you're paying attention, some of you have got to be saying, you know, what is this guy talking about? Just spent all this time telling us about, a few minutes ago, about how it's so much about hard work, and now it's effortless. So which is it? Is it hard work or is it effortless? Well, here's the distinction. The distinction is between the preparation and the process. The work that is involved is in getting to the point where one becomes a good trader. And there is an immense amount of work to get to that point. The actual trading process itself, and here I'm talking as a discretionary trader, that should not be hard work. That's the part that should be effortless. So let's use a running analogy. Picture on one hand someone who has never exercised in their lives getting up off the couch and going out and trying to run 1 mile in 10 minutes, pretty slow, and have that image and that what the struggle would be involved to do that. On the other hand, picture a world-class runner running 20 miles and each mile less than 5 minutes, easy as can be, 1 mile after another. So who's doing more hard work? The out-of-shape runner going 1 mile at a slow speed, or the world-class runner running 20 at a near record pace? And the answer is the more hard work is obviously being done by the out-of-shape person. However, the point is the world-class runner didn't just get up off the couch one day and run a marathon. He did a lot of training and hard work and dedication to get to that point. And so that's where the hard work is. But if he's in a race, if he has to work hard and struggle in that race, it's not going to be a good race. Any of you who are runners will know that. And you basically, if it's going well, it should be really effortless. And it's the same with trading. With trading, if it's not going well, if every decision you make seems to be wrong, if just things are just going against you, you can't say, I'm going to try harder, I'm going to work harder. You can't work harder to make a bad trading streak good. And in fact, what almost every market wizard I've interviewed has told me when asked about how do they handle losing these difficult trading periods, and I'm talking again about discretionary traders, the answer is usually the best thing you can do is not try harder, but to liquidate everything, take a break, maybe even a vacation, come back with a clear head, no positions, begin trading again slowly, gradually, and as things seem to be working again, gradually build back to what is the normal position size. That is usually the best answer. And that's what I mean when I say good trading should be effortless. There is a related story I can tell you about someone whose interview I could not use, and the reason for that was that in order for me to get the interviews that I do, I basically have to tell people, look, I'm going to write an honest interview, I'll let you read it, and if you're not happy that I've done it accurately and not said anything that you feel is wrong, then I'll give you the right to not let me use it. And that makes it easier for me to first get the interviews, but also it opens up people. I always want to get people to be open with me as much as possible. I don't want them second guessing themselves on every word they say. So if they know that they have a right to see the interview and give a final okay, they tend to be much more open. And you'll see, I think if those of you who've read any of the books, you'll see that there is a lot of openness, surprisingly so, in many cases. And in this particular interview, I had sent the interview back to the person, and about a week or two later, I got a call back, and he said, I read the interview, and I said, uh-huh, and he said, it was very interesting, it was good, but there was a hesitation in his voice, and I was waiting for the but, and he said, but, and the but was, turns out that this trader had decided to also go into the hedge fund consulting business. He was a currency trader, and he was going to consult as part of, besides trading, he was also going to consult with corporations about hedging their currency exposure. And he hired a business manager. And what I didn't mention was that this particular interview was filled with very eclectic subjects. We talked about Zen and trading. We talked about dreams and trading, even precognition and trading. Very unusual subjects. Now, his business manager had read this interview. The interview was interesting, but he read this all about Zen and trading and dreams and trading. And this was not the corporate image. It was not what he wanted clients to be seeing. So he said, no way. And the trader said, I'm sorry, you can't use it. And so I was stuck. Now, in this interview, and this is where we come back to this good trading is effortless, there was a couple of pages which were very pertinent to this and which I thought were excellent. They made the point very well. And I said to him, look, let me use just these 2 pages. I'll call you Trader X, and I'll just use this section. And I won't tell anybody who you are. And so we agreed on that, and he let me use those 2 pages. And the conversation went something like this. He said, have you ever read Zen and the Art of Archery? And I said, I'm afraid I missed that one. And he said, no, I am really serious. He said, in trading, just like in archery or any other skill, and I'll get every word exact the way he said it, whenever there is any effort, force, straining, struggling, or trying, it's wrong. And that gets back to the idea that good trading needs to be effortless. And that's true in a lot of things. I said, like, it's true in athletics, it's true in music. I mean, you know, if one's a musician playing effortlessly, it's the best playing. If there's over hard work, it's not. If you're a writer, and I know that personally, if it's going effortlessly, that's the best writing. If I'm struggling with sentences, that's the worst. I will usually get up and go for a run and then do something else and come back and try again. So trading is no different. And that's what I mean when I say good trading needs to be effortless. Okay, now we come to risk control. So I know a lot of you have heard about risk control and say, oh, well, if I know about risk control, blah, blah, blah. Well, the point is, I know you've heard it. But the thing to understand is that almost every trader I ever interviewed said or would say that risk control, risk management is more important than the trading methodology. And for many traders, particularly amateur traders, they have it backwards. They think it's all about finding the right entry approach. And risk management is either an afterthought or it's not even a thought. But the point is, it's really more important than anything else. Now, let me give you some ways of looking at risk that the wizards used. And I'll start with Marty Schwartz. Marty Schwartz, who we talked about earlier. Marty Schwartz said, you have to know your uncle point. Uncle point. Now, that's a idiomatic expression. I don't even know if it's still used. I don't think it's commonly used anymore, even in America. But when Marty and I were growing up as kids, and I know this expression from my childhood, if 2 kids were having a fight and one kid got the other kid's hand behind his back and was twisting it, the kid who was having his arm twisted to give up would yell, uncle. That's what it means to yell uncle. It basically means, I give up. And so what Marty Schwartz is saying, he says, you have to know your uncle point. You have to know what is your give-up point in a trade. That's what he's essentially saying. Now, another trader I interviewed was Bruce Kovner, also one of the world's most famous traders and certainly one of the best traders of all time. Bruce Kovner is the manager of Caxton. Even when I interviewed him relatively early in his career. He had been trading, I think, for close to 10 years at the time. He had an 88% annual return at the time. Of course, that's like impossible to maintain, particularly as it grew much larger and larger. But at the time, he was still fairly large. I think he was managing close to $1 billion, which back in the late 80s was an enormous amount of money. And he said the following about the subject. He said, I always know where I will get out before I get in. Now, why is that so important? The reason is that before you get in is the only time that you have complete objectivity. You can look at things without the bias and influence and emotions of being in the position. So you can make a rational decision. Where should the market, as Bruce Kovner said, where should the market not go if I am right? and he makes that decision before he puts on a trade. Then he puts on a trade, and he then does not have to worry or try to figure out when he's going to get out if it goes against him. Why? Because he's made that decision before he's gotten into the trade. And that is actually one of the most important pieces of advice I can give most people. Is one of the best things you could probably do is make the decision of where to get out before you get in on every trade part of your process. And I think that for many of you, if you haven't done that before, if you do that, you will find that it may be a great help. And even if it doesn't help tremendously, what I can promise you, it will diminish the emotional anguish. It will make trading a lot less painful, because the pain occurs when people let trades get away from them. And I know perfectly well, because I certainly have done it myself. And if I've ever broken that rule, I certainly have lived to regret it. And I think I'm now at a point in my life where I won't do it again, but who knows? Let me go back, actually, one more point on risk control. And that is, risk management does not have to be complicated. There are people who've written books, entire books on risk management. I know of one instance where an author has written multiple volumes on risk management. But really, it's not rocket science. You can get 99% of effective risk management in as little as one sentence. So simply a rule that says never invest or never risk more than blank percent. You fill in a blank. It could be 1%, it could be 0.5%, whatever number is right for your approach. But never, let's say as an example, never risk more than 0.5% on any trade. That one simple sentence will get you 99% of the way to risk management. And particularly if you combine that with the idea of determining where your exit point is before you get in. And so just doing those simple things will get you most of the way there, if not almost all the way there. So the strategy, the risk management strategy, is not hard work. It's not complicated. It's not difficult. Now, adhering to it, having the discipline and fortitude to adhere to it is another story. But the actual plan could be as simple as I've just described it, and yet totally effective. Okay, so went right to discipline. Discipline is going to be one of these other points that I know you will have heard of. And I can tell you that if you went through my books and you look for questions that were along the line, what's the most important thing, or what differentiates you from other people, or what differentiates successful people from unsuccessful traders and so forth, the single most common answer is discipline. Discipline is obviously critical. Now, if I'm going to tell you discipline, you will have heard it a million times before, and my telling you is not going to make any difference. It'll just be one more time you've heard it, and it'll be like water off a duck's back. It'll just roll right off. So let me just tell you a story about discipline, which will hopefully, whenever you're at a point where you're liable to lapse in discipline, you'll think of the story, and maybe then that will make an impression. And the story concerns a trader by the name of Randy McKay. McKay was basically a college dropout, and this was during the Vietnam War, and once he dropped out of college, he lost his deferment, and he ended up being drafted into the Marines, and he ended up in the Vietnam War. He came back, and when he came back, his brother was a trader on the Chicago mercantile floor, and at the time, when he had come back, the Chicago Merc had just launched currency trading. I believe this was in about 1972 or so. And at the time, now currencies are a really big deal market. But back then, futures trading in currencies was virtually non-existent. They had started, but almost no trading occurred. And they were giving away, the mercantile wanted to get some volume, so they gave away seats to the people who had the seats in the livestock exchange. Now livestock is a minor market, how things change over time, and currencies are huge, but back at the time, the livestock traders were getting free currency seats just in the hope that they would get some volume in trading currencies. So Randy's brother got one of these free seats, and he said, do you want to try being a broker? And so he gave him this currency seat. And McKay became a very successful trader, first on the floor, and then after a number of years, moved up to an office so he could trade multiple markets, and had a long streak where he was making $1 million or more every single year. And he was a very disciplined trader. So I'll give you an example how disciplined he was. I go back quite a while. The story concerns 1978. I actually, was involved in markets at the time, so I remember it quite well when Randy told me about it. For those of you who are older, maybe you'll remember. And back in those days, we were having in 1978, we were having a period where the dollar was just going down and down and down and down. Well, again, some things don't change. And the whole year it had been going straight down. And there was a lot of talk about the danger of the dollar getting weaker and all of that. And the trends, therefore, in currencies were all these nice uptrends against the dollar, very smooth uptrends. And what happened was that on one weekend in November, the first weekend in November, President Carter and his advisors had gotten together, and they had put together this rescue plan, which they announced on the weekend. And it was this major dollar rescue plan. And it did have teeth to it. And so when Monday morning came, the currency markets dropped tremendously. Or no, actually, when I say Monday morning in the States, actually they dropped beginning Sunday evening in the Asian markets. And by the time of the U.S. opening, the markets all opened limit down. But it wasn't just a matter of being limit down in the open block limit down. The actual cash currency market was discounting multiple limit downs. So I asked Randy, who as a trend-oriented trader, I knew he had been very long during that period. He was very long the British pound. And I asked him, Randy, in a situation like that, where there's a gap overnight, and you walk in Monday morning, and the market is locked limit, you can't even get out. And the only way you can get out is at the cash market. And the cash market is discounting another 3-4 limits down. Do you say to yourself, whoa, at that amount of limits that far down, I might as well wait and see if the futures market trades before it goes down that many limits? Or do you just get out 4 limits down in the cash market? And he said, there's nothing to think about. I was wrong. It was way beyond my exit point, even at 1 limit down. There was nothing to think about. I got out. So he actually got out, locking in a loss of 4 limits down just because the market was past this point. He's disciplined. He got out. Okay, so he's a disciplined trader. Now, flash forward later in his career. This is about 1986 or 87, I believe. And Randy, this is the story of McKay's next to last trade. Now, his last trade, his plan was to make $50 million and use the money to buy a Major League baseball team, which was doable back in those days. And this trade, the plan was to make $25 million, which he was going to double to $50 million in his last trade. And so this next to last trade, as he called it, was being long the Canadian dollar. He was very, very bullish on the Canadian dollar. He traded lots of markets, but his only big position was the Canadian dollar, and he had something like a 7,000 contract position long the Canadian dollar. At the same time that he was of this position, he was having a house built in Jamaica, and he explained how unless he went and supervised the construction, nothing would get done right. So he would go back every week or two to check on the construction, and one Sunday evening he's ready to go to the airport. He's actually late for his flight. The car's waiting outside to take him, and as a last minute thing, what he does, he looks at the quote screen, and what does he see? He sees the Canadian dollar, the only position he cares about, down 100 points. Exactly, 100. So McKay thinks to himself, wait a minute, the Canadian dollar rarely moves 10 points in the overnight session, let alone 100. And so he rationalizes to himself that it must be a bad quote. The market's unchanged. It's off by a digit, though, at the 100 level. And that's what he rationalizes. He rushes out, gets his car, catches his flight, and then he discovers that next morning that the quote was not a bad quote. It was actually a correct quote. What had happened was there was a poll taken, and the Liberal candidate, who everybody thought was had no chance of winning, did very well, and all of a sudden there was a real chance he might win, and that completely changed the psychology of the market. And the market had broken sharply, Canadian dollar broken sharply. And so it was down 100 points when he looked at it. He was down 150 points the next morning. And so he kind of waited a couple of days, and he doesn't even have a phone. His house is being built. This is pre-cell phone days. And so finally he calls. He has to go to the hotel and wait online, as he said, with the tourist to be able to check where his positions are. And he gets the phone, he calls the floor, and they tell him he's down like about $7 million. And he says, just get out of everything. And he gets out of it all. But here's the point. A disciplined trader, he had literally a 1-2 second lapse of discipline, and it cost him $7 million. The market is amazing. It will not let you get away with any lapse of discipline. Now we come to the idea of independence. The great traders are independent thinkers. They don't listen to other people. Michael Marcus, who I started out talking about, as you recall, he said every trader needs to follow their own light. He said even if you take two really great traders and put them together, you'll get the worst of both. And by the way, when he said that, I'm sure he was talking about himself and Bruce Kovner of Caxton, because Michael was the one who hired Bruce, and originally while they were at Commodities Corp, the two worked together or traded from the same room. So what he's saying, even if you have traders as talented as he and Bruce Kovner, and if they were to meld their opinions, you'd end up getting the worst of both. He says you have to follow your own light. And I can tell you a personal story which happened to me, and I'm not making any of this up. This happened exactly the way I'm going to tell it to you. And this goes back many years. And at the time, when I was a director of futures research for a brokerage firm, and I traded my own account on the side, and I had a lousy few months. I'd given back my profits for the year. I was about flat. I had cut back my trading, and I didn't have many positions on anymore. And one day, one of the traders I interviewed had a habit of calling me periodically to get my opinion on the markets. Now, basically, I was a technical analyst. I was a research director. I was also the technical analyst for the company, and he just wanted to get my technical opinion on the markets. Now, he was a million times better a trader than I was. Why he wanted my opinion, I can't tell you, but he did. So one day he called me, and this was during this time I had not done well recently, and he got the various markets. I'm giving him my ideas, and he gets to the Japanese yen. And this was one of the few markets I had a strong opinion on, and it was the only market I had any position of consequence on, and I was short the yen. And I said to him, I said, the market has gone down. It went down very sharply, and now for the past week or so, it's been in a very, very tiny consolidation. My experience is when a market does that, when it goes down very sharply and then goes into a very tiny pattern, most times it will go down again. So I'm bearish. And he went, Jack, no, you're wrong, because he gave me this oscillator is overdone, this thing is overdone, this is why the market's... He gave me 50 reasons why the market was oversold. And I said, look, you're probably right. It's just an opinion. I don't know. I'm just telling you what I think. You're probably right. Whatever. So I hung up the phone. Now, even then, I knew enough not to listen to anybody, even from people who knew a lot more than I did or were much better traders than I did. But here's the thing. That particular afternoon, I had to leave for a business trip to Washington. I knew I had lots of meetings. I knew I would not be able to follow the markets. And So even though I knew it wasn't the right thing to do, I rationalized, well, I haven't been doing very well. I've only got this one position on. And do I really want to go opposite one of the best traders I know? But most importantly, and here's the rationalization, I won't be able to follow the markets. So what did I do? I walked over to the overnight trading desk, and I put an order to get out of my yen position. Now, I came back a few days later, and I'm sure none of you listening will be surprised if I tell you that the yen was down a couple hundred points. Now, here's where you have to believe me. The same trader called me that day. And I was not going to be so presumptuous as to bring up the yen. But fortunately, on his own, he brought up the yen. And I said, oh, the yen, like I played dumb, like I was just remembering what he said. And I said, by the way, are you still short, are you still long the yen? Because remember, he had been bullish and I was bearish. And he said, long, like in surprise, long, he said, I'm short. Now, what I didn't tell you is he's a very short-term trader. For him, a long-term position might be one day. Lots of his trades were very, intraday. I was a longer-term trader, thought in terms of months for a position. So when he told me he was bullish, he probably, he was long. But then he probably saw the market wasn't acting right. Few ticks, the market moved some ticks against him. He probably reversed his position and ended up short. So I, who was right all along, made nothing, and he did quite well. The point is that you can't listen to anybody else. You have to, as Michael Marcus said, follow your own light. Confidence is a very important element. It's a way I find that the traders who are really good have the sense of confidence. And one of the best ways I can demonstrate it is with a question I asked a number of traders is, and when I said to myself, if I'm going to be doing these interviews, I'm going to ask the stuff I want to know. And one of the things I was curious about is, hey, you've made all this money. Why don't you just, take it and put it in the bank? Why continue to risk it? So that seemed to be a logical question to ask. And the answers I got were informative. Paul Tudor Jones told me, I take 85% of my money and I put it where? In my own funds. Why? Because it's the safest place for it. That's his reason. It's the safest. This is from a futures trader. In his mind, putting money in his futures fund that he controls is as safe as T-bills. And what does that tell you? It tells you he's extremely confident. And by the way, somebody like Monroe Tapp went and won better. He told me he had put 95% of his money in his own funds. So that tells you that they have great confidence. This is a point that a lot of people don't understand. This is not one of the things that people tell you all the time. And that is that you must understand that losing is part of the game. Linda Raschke, who was one of the women traders I interviewed, originally a floor trader, and after a horse riding accident went and traded from an office and was very successful from both. She, at one point in our interview, said, it never bothers me to lose because I know I will always make it right back. That sounds like an arrogant comment, doesn't it? But she's not an arrogant person. She doesn't make a big deal of herself. She's not boisterous or egotistical. What she's basically saying is, I have a methodology. It's going to win and it's also going to lose along the way. But I know if I stick with the methodology, even after it loses, if I stay with it, it will eventually come back and I'll come up to a new high. So the important thing for her was understanding that losing is part of the process. You don't go from A to B without losses in between. And all good traders understand that. Now, good traders do, but amateur traders don't. Marty Schwartz, I had an very interesting comment on this point. I had asked Marty, look, you spent all this time losing money, and then all of a sudden you became this phenomenally successful trader. He said, what changed? Well, how did you change from a losing trader to a winning trader? Well, part of it was he changed his approach from fundamental to technical. Certainly that was critical. But it was more than that. What he said was the critical thing was, he said, I became a winner when I understood it was okay to lose. What is the rallying cry of a losing trader, he said? He said, it's when I get out, I'll get out when I'm even. That's what a losing trader will say. I'll get out when I'm even. Why is getting out even so important? Because, think about it. If you get out even, it means you did not make a mistake. You were not wrong. And the need of people to not be wrong is so strong that, ironically, it causes them to lose. It's the very trying avoidance of taking a loss that leads to the big losses that cause people to fail completely. So you have to understand that losing is part of the game. Another very important point is patience. It's, by the way, one of the reasons why I'm naturally not a good trader, because I'm very, very impatient. You could ask my wife about how I am in traffic jams. And I have to fight against that insofar as trading. But good traders are very patient. Now, let me give you a quote out of a book. This book is a book which many of you may have heard of. It's called Reminiscences of a Stock Operator. It's a very famous book written not by Jesse Livermore, but about Jesse Livermore as a fictionalized account of his trading. And it was written by a writer called Edwin Lefebvre, who was a real writer. It wasn't Livermore who wrote that book. And he captured it so well that for a while people thought that it was really Livermore using a pseudonym for the book, but no, Lefebvre was actually a different person. Now, in that book, there's one point where he says, there's the common fool who does wrong at all times. And then there is the Wall Street fool who thinks he must trade at all times. And his point is that you have to know when to trade. Now, Jim Rogers, who I talked about, has a very good saying on this. He said, I don't do anything until, and he points to the floor, corner on the floor, and he says, until there's money lying on the floor, and all I have to do is bend down and pick it up, I don't do anything. His point is, until there's something so obvious and so strong that it's just like taking money off the floor, he waits. And so that's the patience. The patience is also very critical to staying with a trade. The same book, Reminiscences, has a quote where the protagonist is explaining why he was successful. And he says, it was never my thinking that made the money. It was my sitting. Got that? My sitting. What he's saying is, look, it's not that I was so smart. It's not that I knew things that other people didn't know. What it was that when I was right, I stayed and I stayed and I stayed with that position. And that's an important element of long-term success, is taking full advantage of the positions when you are right. So patience is important both in getting in, waiting for the right trade, and in getting out, staying with the position when it's correct. Now we'll talk about loyalty. Loyalty is a very nice trait. It's a good trait to have in friends, in family, in pets, but it's a very bad trait for traders. As a trader, you don't want to be loyal. You want to be the exact opposite. The best story I can give you concerns Stanley Druckenmiller. Druckenmiller is also one of the great traders of all time. He ran his own Duquesne fund for like 30 years. He compounded, annualized about 30% over 30 years, one of the great records of all time. He also, many people don't realize that the Quantum Fund, for maybe about 10 years, was not run by George Soros. It was actually run by Stanley Druckenmiller. And because Soros was in Eastern Europe and the Soviet Union spending his time trying to get those countries to more capitalistic societies. So that was his big hobby and venture, and he turned the running of the day-to-day trading over to Druckenmiller. Now, Druckenmiller, back in '87, worked for Dreyfus, and he was running 7 mutual funds for the different funds. And this story begins on October 16th, 1987, which is a Friday. Now, on that day, and For those of you, some of you will know what date that is, but for those of you who don't, that is the last trading day before the great crash of October 87, which is the largest one-day decline ever in the U.S. markets by a very, very wide margin. Now, on that Friday, Druckenmiller had been short, and he decided that the market had come down enough. Many people forget that before that crash in October 87, the market had been falling sharply for a while. And that Friday, he felt the market was a support. He covered all of his short positions, and not only that, he went net long. Now, I used to ask people when I gave talks, did anybody ever make a worse mistake? And I stopped asking the question because I realized it was impossible to even make up a worse mistake. How could you do anything worse than go from short to long on the day before the biggest one-day loss ever? And so what happened? The interesting thing is, by the way, if you go and look at Druckenmiller's record for October 87, he actually didn't lose much that month, which sounds impossible. How could you not lose much going into the crash net long? Well, he was short up until the October 19th date, and he was making money on that. But here's the important thing. That weekend, before the after he got long and before the market opened, he realized he had made a mistake. He realized the market was going to continue to go down. Now, why he realized it is tangential. It's in the book if you want to go into it, but we don't have time to go into it here. But the key is that he had made a decision that he was going to get out. What he didn't know, though, was that come Monday morning, it wasn't a matter of just getting out. The market started out about 12% lower. The market opened up with a tremendous downside gap. What did Druckenmiller do? He got out of that whole position he had gotten long Friday, 12% down right as soon as the market opened up. He just got out of everything. And not only did he get out of everything sharply lower than where he got in, he actually went back net short again. Now, there are very, very few traders in the world that would have the strength, the fortitude, the flexibility to be able to do something like that. And that's why he's a great trader. The thing, though, is it's the epitome of no loyalty to a position. He didn't sit there and hope that maybe the market's going to come back or hope that maybe he's wrong about his making a mistake. He thought he decided he was wrong, and market unchanged or market down 12%, it made no difference. He was wrong, he was going to be out, and not only was he going to be out, he was going to go back the other way. He had no loyalty to his position. Now we come to, we have a couple of last points to make, and then I'll go and we'll take questions. So this is the idea that was proposed by Bill Eckhart. Eckhart, many people, well, people would know him from my book, but otherwise I don't think a lot of people would know Eckhart. He is a CTA who's traded successfully for a long time, but his main claim to fame, he was Richard Dennis's partner. And they were many people, if you know about this group of traders called the Turtles, they were trained by Richard Dennis. They were actually trained by Richard Dennis and Bill Eckhart. Bill Eckhart is a PhD mathematician and has been a systematic trader for decades and done very well. Now, Eckhart said that human nature is so poorly attuned to trading that most people will do worse than random. Now, you know the academics who say that even a monkey could do as well as the professionals by throwing darts at the Wall Street page. Bill Eckhart is not saying that. Bill Eckhart is saying the monkey is going to do better. Why? Because the monkey is going to be uninhibited by human emotions. And human emotions, through evolution, have come to a point where they are not only not beneficial to trading, they are net detrimental. That is what he means when he says people will do worse than random. Because why? Because he says people have evolved to seek comfort. They want the comfortable thing. They want comfort in shelter, comfort in food, comfort in sex, comfort in every way. And the markets do not pay off for being comfortable. The markets will pay off for doing what is the uncomfortable thing. And that's what he means when he says, well, people will do worse than Randall, because our evolutionary traits will make us do things which feel good, but which are wrong. And therefore, we will do even worse than if we flip coins to make decisions. So we'll have two last points here. This is the next last point. This is one where, again, it's one of these things you don't hear. It's not a common piece of advice. It's actually only one trader actually mentioned this, I believe, that I can recall, and it was Marty Schwartz. And his basic thing was, he said, if you ever really worried about a position and the market lets you off the hook easily, don't get out. Don't get out. Now, it turned out there was another trader who I interviewed, Bill Lipschitz, who's a very successful long-term currency trader, and at the time was the largest currency trader for Solomon and traded very large size, billions of dollars of currency positions. And at the time, he had a very large position, $3 billion, long the D-mark against the dollar. And this was one Friday afternoon. Gorbachev was giving an address at the UN. And Gorbachev said the Soviet Union was going to cut its military spending. The markets took that to mean that, oh, wow, they're going to do that, then the U.S. is going to cut military spending, and that's going to be good for the dollar. And the dollar started rallying. And here's Lipschitz sitting with a very large short position, long position, short the dollar, but long in D-marks against the dollar. So he tries to force the market against this position. He short the dollar against the D-mark. He sells more dollar against the D-mark. And what does the market do? It absorbs it like a sponge. And Friday afternoon, there's very little liquidity in the markets, in currencies, because Europe is closed and it's just the U.S. market. There's not a lot of liquidity. So he knows he's got a problem. And he walks over to his boss and he says, we have a problem. And his boss asks him, what's wrong? And he said, I've got a large position long the D-mark against dollar, and I've misjudged the liquidity of the market. He said, how bad is it? He says, well, we're down about $70 million on the position right now. What's the game plan? He said, well, I can't do anything in this market. The only thing I can do is wait for Sunday for Tokyo to open and to try to work out of the position. He said, okay, we'll do what you have to do. So Lipschitz waits over the weekend. Sunday night, the markets open, currency markets open in Asia, and the dollar is not only not stronger, it's actually a bit weaker against the currencies than D-mark. So his position's a little bit better. So I said, so then you got out? He said, no. He said, I didn't. And he said, no, I waited. I watched it all night long. And in the morning, the D-mark had rallied back quite a bit, and I got out. And I only lost about $18 million on the position, which after being down $70 million on Friday's close, worried about it getting much worse, getting out at $18 million seemed like a wonderful conclusion. So he's very happy with that. So I asked him, why didn't you get out Sunday night? And he said, because it would have been the wrong thing to do. And it's a perfect illustration of Schwartz's point about not getting out of the market if the market lets you off the hook easily. Why? Why is that true? Because think about it. If you are really worried, if you're in a position and you're really worried about it, say over the weekend, it's because of something, it's something that everybody knows. You know, some market action, some fundamental news. Like an example I just gave you, there was news that come out. The dollar had closed very strong against the D-mark at highs of the week. And, you know, everybody knows it. So everybody would be who's short the dollar in a situation like that, or whatever market might be, would be panicked and wanting to get out. It's not just you. But if despite that widespread knowledge and a market that looks like it's going to go against you as soon as the market reopens, if despite all of that, it lets you off the hook, it lets you get out easily, it means that your position is probably right. It means there's probably a lot of smart money in the same direction as the trade. So that's the explanation of why this basically works. So the last thing, and a short point, and that is, if you listen to the language of traders, how do they talk about trading? Bruce Kovner, it's a three-dimensional chess game. Jim Rogers, it's like a jigsaw puzzle with 10,000 pieces where they're constantly taking out some pieces and throwing in new pieces. Ryan pats his chart book and says somewhere it's a treasure hunt. It's a treasure hunt. Somewhere in here is a treasure and I'm going to find it. And there's other examples as well. And what are all of these? What is that language? It's the language of games. And what does that tell you? It tells you for these traders, trading is something they love to do. It's like a game. It's almost something like they would do even if they didn't get paid for it. And so that love of trading is really essential. And I would tell you, if you look around and people that you know, and it doesn't have to be trading, it could be anything, the people who are successful, I'm sure, in almost every case, the people who you know who are successful are people who love what they're doing. And so not everybody loves trading. And if, for those who don't, then maybe trading is not the thing. Wanting to trade because you want to get rich is certainly the wrong reason. The people who are successful are the ones who love trading for its own sake. And so that is an essential key to success. So those are some of the really important key points about trading success, and some of the things I've talked about I think are important to success in general. And at this point, I'll open it up to questions. Questions?
Jack, I have put the questions in your chat window. If you can see, I was gathering some questions.
Oh, okay, sure, no problem.
While you were presenting, so you have a couple of questions there.
Okay.
Can you see it?
Maybe I have to open. Oh, here it is. Questions. No, I had to open it up. Let's see.
It's in the chat window.
Oh, in the chat window. Okay, let me see. Oh, here. That's why my chat window is not open. There we go.
Exactly.
Okay, losing is part of the game. Does that mean to close a trade, losing, you understand something like hold position that we can be negative at a split? Yes. So good question. And the second part of that is the right way you look at it. It is that a correct trading approach will sometimes hold positions that will be negative for the moment and can end up being negative. So it's not that, well, trading a losing position is also important if it's part of it, if it's gotten to the point.
I'm Jessica Minden for IB Times TV reporting from the floor.
Plan is to get out. So I guess in a way, both parts of that are important. So if you decide that, as I suggested, you decide where to get out before you get in, and the market has gotten to that point, if it's that type of a loss, then you should get out. But if the market has not yet gotten to that point, then you shouldn't get out. You should basically stick with your methodology. Well, when I was talking about losing being part of the game, there I'm specifically referring to the idea that no matter what your approach is, it's going to involve losses along the way. And taking losses doesn't mean you made a mistake. You could take losses and it could still be a good trade. So people shouldn't confuse losing trades with bad trades, because if you have a process and you follow it all the time and you lose and you did everything that you were supposed to do, that's not a bad trade. That's a losing trade. So there's a big difference. Okay, next question regarding the slide, the comfortable thing. Why do you say?
Jack, wait a second. You still have some questions above. If you scroll up.
Oh, scroll. Oh, okay. Oh, I see. Okay.
Yes. Let me just ask the attendees to make questions if they want. Se alguém tiver alguma questão para colocar, pode colocar agora na vossa janela de questões e eu passo-as então para o Jack poder responder. Portanto, estejam à vontade agora para colocarem qualquer questão que entretanto não tenham colocado. Eu estive a colocá-las então na janela de questões dele para responder. Portanto, estejam à vontade então para colocar as questões que quiserem, que eu passo então ao Jack. Okay, Jack, you can keep going.
Okay, great. Okay, so we'll go to the first question up here. So, an emotional person, difficult to trade. And the answer is yes, in generally speaking. I think Well, it depends. I mean, well, yes and no. I mean, some of the traders I interviewed are emotional people. I mean, some are very relaxed, but some are emotional. So it doesn't mean, I don't mean to imply that people who are emotional can't be good traders. But the emotions don't affect their methodology. So somebody like Schwartz. Schwartz is, give you an idea, I don't think anybody has lasted working for Schwartz for more than 4 weeks. He's a very volatile person. And, you know, he used to, in fact, he was in the Marines at one point. He still has a bit of that personality. So he may be emotional, but when it comes to trading, he's got his methodologies, he's got his way of trading, and he follows it. He doesn't let his emotions affect the way he trades. So it doesn't mean you can't be emotional, but it means that you don't want to be emotional in trading. And the way emotions are bad, for example, if you go into trades and you don't decide where to get out, and then you're losing money, that type of emotion, that, you know, which is going to affect, you know, deciding how you get out or if you get out, that's a bad type of emotion. So that's what I mean. But it doesn't mean that you have to be basically a steel hard person as far as emotions go. Okay. I said.
Can I ask you just to please speak a little bit louder? We have been giving
louder again. Okay.
the bad feedback about the sound.
Yeah. Okay.
Okay. Or closer to the microphone.
Sure. I am pretty close. So you're very clear,
Okay.
and I am actually in this room. It's loud. I don't know why it's not transmitting loud.
Okay. Thank you.
Okay. So, but I will speak extra loud.
Thank you.
So you said, okay. So how you said 2 good trading. Oh wait. There was a question here before. I see. Oh, I see. They moved down while I was talking. Okay. Michael Marcus. Wasn't Michael Marcus a beginning in trading a 50-50 paradox as well? Well, yes. He in the beginning he basically, well, what was a 50-50 paradox was when I told you he went from 3,000 to 30,000. So he thought he was a genius. That was the 50-50. He really at that point did not know what he was doing. He just happened to buy corn in the year of a blight. And so, yes, that's a perfect example of a 50-50 proposition. It wasn't that he was an expert trader. He had great talent, but it wasn't talent that he had developed yet or discovered yet. So at that early point, that particular one step of success before he gave it all back again, which is what will happen if it's pure luck, that was part of the 50-50 luck thing. And that's what makes people think, as Marcus thought, he was a genius at that point. He was, but not because of what he knew at that point. He did have the skill, but it was nothing that was evident yet. Eventually, though, he did develop the skills and the talent. But at that point, he was like the beginning trader. Okay, now I'm going to go up to the top each time. Okay, next question. Why is it common for many successful traders to experience bankruptcy before they became successful? Because it's common for everybody. I mean, bankruptcy, depends, because the thing is that trading is, to win at the markets is not easy. People can do it by luck for a while, but if they haven't yet developed the methodology, if they don't yet have the skill, they don't yet have the risk management understanding, then the odds are very strong against them winning. Plus, everybody's paying transaction costs. There's slippage in the trades. So even if you were 50-50, you would still lose because of transaction costs. So the odds are against everybody, including people who end up being very successful. But in the very beginning, they're not great traders yet. They have still to learn the craft. And so that's why, it's the same reason why most people will start out losing is the reason why they lost. And it's the reason why I tell beginning traders, people, if you're beginning trading, always begin with a small amount of money, even less than you think you can risk. Why? Because there's a good chance you're going to lose it, and you might as well get the education for less money. Okay, let's see. Next question regarding the slide, the comfortable thing. Why do you say people trade randomly? No, I didn't say people trade randomly. I was quoting Eckhart, who said, that people will do worse than random. So that's my point. My point is that human nature is so poorly set up to trade that our natural instincts will make us do even worse than if you were flipping a coin. You will do worse than a monkey throwing darts at a page of quotes. Our natural instincts will make us do even worse than random. It's like if you're flipping coins, the odds are, if you're calling heads or tails, the odds are you will be 50% right, just because those are the odds. However, what Eckhart is saying is that in trading, people are not going to be 50% right. They're going to be right less than 50% because the things that they naturally want to do are going to be things that are going to be negative to trading. So they will do even worse than random. That was the point. It wasn't saying that people trade randomly. Unfortunately, it goes down each time, so I have to scroll back and find a spot.
Maybe you can detach the chat window from the whole.
There we go. I got back to the thing. Okay. Is there a recommendation for minimal time frame for a beginner between getting the concepts down, simulating and demonstration platforms, or virtual and starting? Okay. There's no particular time frame. So, but let me go. It's a good question, an important question. So the process is first do a lot of reading and research. Try to figure out what is the methodology that feels comfortable. Develop it. Try it in paper trading, follow markets. And once that seems to be going well, remember that paper trading is going to be very different because emotions aren't part of it yet. But once you've got the methodology and it seems to be working and you've got a risk management plan, at that point you can take a small amount of money and try it in real trading. So the amount of time will depend on the methodology, the person. There's no real length of time that one can say is the answer to that. Okay, next question. Which of these is most important component to become a good trader? They're all the things I talked about are important. Every one of the ones I mentioned in this talk is an essential point. And there's more than the ones I talked about. I actually have two talks on this subject, and so there's a whole bunch of other points which I didn't even talk about, and there's even more points than I have in both talks. So they're all important. It's not like just one is important. Which is the most important component? Again, same answer. There's no single most important. There's a lot of essentials there. You can't say, picking up an approach that fits your personality, risk management, discipline, all of these things are important. You can't pick out one that's the most important. It's like saying which tire on your car is the most important. Well, I mean, a car, in this case is only 4 tires, but picture the same analogy. They're all important. Any tire you take away is going to be a problem. You said 2 good traders bring the worst of both, so you think mentors are indispensable. Okay, yes, but it doesn't mean yes and no. You can learn from mentors, but you ultimately have to develop your own methodology. Marcus was a mentor for Kovner. Kovner's trading approach was completely different from Marcus's, but he learned certain important things from Marcus. And Marcus, in turn, learned from Sakota, who I didn't speak about. And Ed Sakota and Marcus's approach was different than Sakota. But Ed Sakota was a very important model in teaching things, Marcus, the importance of staying with trades and things that did fit to part of his methodology. So yes, mentors can be important to learn things from, but not to copy. The mistake people make is they want to have somebody give them the whole trading approach on a silver tray. That's not the way it works. Okay, what are the 2-3 essential steps to methodology, to define the methodology? Okay, I kind of answered this before. I said the first step is just reading and research and just find out what things resonate with you, whether you're inherently going to want to be a fundamentals or technical or both, which markets, whether you want to be stocks or futures. Just these are things you have to discover. You have to read a lot, maybe it's options even. So you have to get to the point where something resonates. And when it does, then you start applying it to the market with paper trading and developing a methodology and risk management. And that's the process. Next one. Why is it common for many successful traders to experience bankruptcy? Oh, we answered that. Don't you think the key point in trading is always to cut your losses short and try to let wins go? Yeah, I mean, that's a common saying, and it's essentially true. It's essentially true. You want to keep your loss, and I said the same thing in a sense when I was saying never risk more than X% on a trade, and have the patience to stay with winning positions. So yeah, those are essential elements. There's a lot more essential elements, but certainly those are both very, very important, and I would agree with that statement. For your trading is for like a game or a business. Okay, so for me, for full disclosure, I am not a trader. I write about traders. I've interviewed lots of traders. I've allocated. I trade myself, but it's not a business for me. It's not even remotely a close full-time occupation. And in fact, I am so occupied with other endeavors like writing books, giving talks, consulting, that I really don't have time to be watching the markets. Now, if I thought that my great talent was as a trader, then that's what I would do full-time. I don't think I have the perfect instincts in nature to be a great trader and trade for a living. And so I've made different choices in my life, and nor do I personally find trading something that I love to do. It's not, and I said that love of endeavor is what you need to have. So to me, trading is like a hobby. Sometimes I do it more, sometimes I do it less, but it's not I don't consider myself a trader by vocation, and that's basically the answer to that. So I don't see it like a business at all. Be closer to a game, I guess, than a business. Why is an edge so important? Well, because if you don't have an edge, you can't possibly win. So like I gave the example of a casino, you can't win at a casino because the house has the edge. So if you treat trading like a casino as a betting game, yeah, you may win for a short term, but you're going to lose money over the long term. So unless you have an edge, you just cannot. It's impossible to win over the long run. Yes, you could over the short run, just like somebody can walk over to the roulette wheel and put it and bet on 18, and 18 comes up and they win 36 times their money. But if they do that constantly, they're going to lose it all. So you can't win without an edge. What percentage of equity is a good goal to shoot for on a yearly? Oh, what percent return? Here's a good. This is a point I sometimes make in different talks. I don't particularly think targets are a good idea. Why? Because the opportunities are not always there, and the opportunities are not always the same. And I can tell you, I can remember one interview where a trader was telling me he always wanted to make at least 10% net every year. In 1 year, he was only up 7 or 8%, and only a couple of months left. And so he took a trade that was sort of marginal, and sure enough, he lost another 1.5%. So instead of getting closer to his target, he ended up further away. You know, putting on a trade to make a target is the wrong motivation, and you don't want to tempt yourself with that. So I don't think that targets are good. You can have goals, but you shouldn't trade, and you shouldn't put on trades for that goal. The main thing is good traders don't look to make a specific return. Good traders look not to lose money. And whether they make a lot of return or a small return, will depend on the opportunities and the year. Let's see, oops. I think the full concentration of trading is on the, full concentration, full focus on trading is the key. Yeah, I think that's really important. You have to be fully devoted, and indeed, that is why I'm not trading other than just a little bit, because I can't do that. I just don't have the time. Many days I can't even look at the market. So my advice, if somebody told me that, I would say, well, don't be trading now. Or if you trade, just trade very little and have stops in and everything. And essentially that's what I do. So yes, I agree that unless you are able to give full concentration and focus on trading, that it's probably not a good idea. And if you're treating it as a hobby, then you need to trade accordingly small and still have the risk management in place. In the future, will algorithmic trading let any space for human discretionary trading? Well, yeah, I think it's getting more difficult, though. I think it's getting more difficult. Probably, if you look at returns of this, good discretionary traders now, I think they're lower, considerably lower than they might have been 20 or 30 years ago. Will it ever get to the point where algorithmic trading won't leave any room for human traders? No. I don't think it's quite that extreme. Now, let me explain why. Because I think that the markets, let's take chess as an example. And I'm sure most of you are familiar with Deep Blue, the IBM program that eventually beat Kasparov, the world's best chess player. And so eventually computers got strong enough to beat the best player. But there's a big difference between chess, and while chess has an extraordinary number of combinations, it's still only 64 squares, and when you're at certain points in the game, there are certain limitations, and there are algorithms that limit the amount of logical choices. So with supercomputer power, it becomes something that's feasibly or doable. And the rules are always the same. It's always, chess is more like the physics of planets. You can use physics, you can define exactly where the orbits are going to be at any point in time and so forth. But the markets and economics are far, 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 far more complicated. There's hundreds of effects, and even worse, they're greatly influenced by humans and human emotions, and those don't go, they have certain patterns, but the timings tend to be very different, and it's more of a chaotic thing. It's more like the weather, where small effects can have very large effects longer term, but it's impossible to go too far in the future because of all those effects. So the problem is too complex to ever solve, no matter how much computer power you have, because that human emotion element in it, and because there's so many hundreds of possible variables, and because human history and events are always changing. So there is a space for a very talented trader with a good discretionary feel, or the trader who can pick out the one important element that's driving a market to still make money. So my belief is that as advanced as computers will get, the last place they will be able to take over completely from humans will be trading. But it may get harder. Okay, what is the importance of the role of intuition? Oh, intuition and trading. Good question. Okay, so it's important. And for some people, some people have it and some people don't. Now let's first get rid of a misconception. There's nothing mysterious about intuition. It's not any magic. It's not any black magic. What is intuition? It is simply subconscious experience. So traders who watch the markets every day, year in, year out, they get a tremendous amount of experience. They see so much. And somewhere along the line, they're watching a market and they feel this market is about to take off. Why? They may not even know why. But somewhere in their subconscious, that particular pattern or some combination of events or some combination of charts or whatever has triggered in their mind a similar situation in the past, and that's why they have the intuition. So the intuition doesn't come out of the air. It's simply a subconscious experience. So for those people who have intuition, I would say yes, you would find that it is probably certainly helpful on balance. Okay, let's see. Here we go. What kind of assets are Jackson? Okay, so my role essentially is, as far as I'm involved in trading in any real way, it's as an allocator in futures and FX. So I consult on several portfolios where money is allocated to futures and FX traders. So my role is an allocator, not as a direct trader, and it's in the futures and FX markets, or to traders who trade those markets. What is your opinion about the Elliott wave theory? Okay, I heard the story about the short yen, and you were kind of defending the theory, keeping short after bearish consolidation. Oh, well, that has nothing to do with Elliott wave. That has nothing to do with Elliott wave. That is basically pattern. That's just a pattern that I noticed in markets, and I can tell you why I think that pattern works. It is simply because the market goes down a lot, it's temporarily sold out, but yet it's so negative that it doesn't matter. The market still can't lift its head, and so you get the market showing some stability, but eventually it just falls down again. So, and of course these things only work a certain percentage of time. And what I'm basically saying, it just works more often than it doesn't, but it's absolutely nothing to do with Elliott wave. Do you really think that these best practices are still valid? Yes, yes. Everything I've talked about today is absolutely valid. Every point I talked to you about today, I think is still valid. So there may be some things that change, but those are not the points I was talking about. I'm talking about things that I believe are totally timeless. And I believe everything I've told you today is still as valid as it was 25 years ago. And I think it's going to be valid 25 years and 100 years from now. Do you really? Yep, I just did that one. A few weeks ago, I lost small because I had a stop loss higher than I should. The price reached my stop, and I was scared to lose it all. Next days, it dropped again, and now came back from bought price. Do you name that discipline or stupid? So if I'm understanding the question is that you didn't give the market enough room because you were scared to lose it all, and then the market came back. I believe that's the question. And is that discipline or stupid? Well, I think it's discipline. And if you go back to one of the things I said in this talk, which was pick your exit point before you get in, and have the discipline to stay with it. So basically, if you did that, then if it wouldn't have gotten to the stop point, then you would have still been in the trade. However, it does. I also would say that if it doesn't get to the stop point, then your opinion on the market changes, not because you're afraid of losing, but because you believe something has changed, or you see something negative that you didn't see before. That's different. But if nothing has changed, then sticking with the discipline and the original plan is probably best. If all the libraries and bookshops have been closed and you can only save one trading-related book, which would it be? Okay, so I'm going to answer this question. Not because I would say not naming any of my own books. I would say that Reminiscences of a Stock Operator is probably the single best trading book that I would recommend. And it's not going to give you any techniques any more than my books will. But it's the book that the traders I interviewed cited as most important, unless they were more recently, which some of them would cite my first Wizard or two Wizard books. But basically, if it's somebody else's book, Reminiscences of a Stock Operator is the one I would consider the best other trading book. And the one I was actually using as a goal of what I wanted to achieve. Do you think the markets are ruled by secret universal? No, no, no. I don't think that's actually that's one of the points I was making. It's not, there is no one true path. There is no mathematical formula. There's no GAN, there's no Elliott wave, there's no single way. And there's, lots of controversy about those anyway, I've read that people say that GAN didn't really make that much money or didn't die with much money and all that. So and all of those approaches are very open to interpretation as well. I do not think that the markets have any mechanical way. I believe that there are mathematics that can extract certain patterns with probability, but there's no magic formulas. And those patterns may change over time. So a lot of people who are very mathematically oriented and trade the markets through mathematical approaches, they may do well, but they end up also changing those approaches over time. So I don't think there is a universal law. There may be things that work more often than they don't, but not to the point of being trade-alone situations. Do I think insider trading are taking over the markets? I have no way of knowing how big insider trading is. I honestly believe it's probably not as big a deal because you always hear about it. I mean, there's billions of trades being done, and you hear, every now and then you get some insider trading situations. So you get them, but I don't think in the scope of things that they are tremendously important. Moreover, a technician would tell you that if insiders, let's say, are buying a stock, that they would see it in the charts, or whatever. So, is fear the worst enemy? Well, fear is a bad enemy, yeah. I don't know if it's the worst. Maybe it's the worst. A number of traders make the point that this relates to trading size. You never want to trade so big that fear is an element. If fear affects your trading, then your trading is too big. So yeah, if you find that you're fearful in trading, then you're doing something wrong. You're trading too large, probably, or you don't have stops. So you should never have fear. If you have fear, that's a telltale sign that you're doing something wrong. In a short time, binary options trading will be a better job, successful. Well, binary options are a tool. If you like it, that's a way of trading. Some people may have a predilection to it. If it works for you, then fine. I think it's just another tool, and it may be great for some traders and not right for others. If human emotions drive the markets, shouldn't a trader be well in tune with them? Well, yes, insofar as it's intuition or whatever. But in most cases, emotions are negative. Emotions are like the fear question just before. It's those type of emotions, the emotions of fear, or the emotions of wanting to make a lot of money. Those type of emotions are the emotions that are not good. Having an instinct, being fearful about a trade, may be a sign you should get out. So in fact, I have had traders tell me that, when they wake up worrying about a position, that kind of told them that they were wrong in a position. Okay, I think they've. Let me see. So the point about intuition, intuition is fine, but not emotions, essentially. That's the last question. So are there, I think I've gotten, oh wait, here's one more. What do you think, why do you think the market's repetitive patterns as far back as Smith? It's not the geometry of markets. You know what it is? It's the constancy of human nature. Human beings don't change. Humans are always greedy. They always panic. There's certain human instincts, and that's where the similarity of markets come from. It's not mathematical precision. It's the constancy of human nature. Do you think that you need at least 20 gate? Probably. But if you're trading, it could be smaller. You could just trade smaller. So you could trade mini contracts and futures for less. You could trade small numbers of shares probably for less. So you probably can try to get by with less than 20, but you have to trade very small. But 20 is probably, I think if you're going below 20, you're getting awfully small, and you have to recognize that. Are there recommended markets or types of assets to begin? No, I think that's a matter of what's right for you. I think, basically, probably either futures or stocks. It depends on your predilection. What do you think about high-frequency trading? What I think about high-frequency trading is I think it's the concern about high-frequency trading I think is overdone. Yes, they're pulling money out of the markets, but you know what? I go back a long way. Before there was high-frequency trading, there were brokers on the exchange floors, bid-ask with wide bid-ask spreads, and they were pulling a lot of money out of the markets. And the spreads now are narrower. So in a sense, the markets are more liquid now. Yes, you still have these traders who are making liquidity pulling money out of the markets, but there was always middlemen pulling money out of the markets. And as far as most traders go, the high-frequency traders are just trading for very, very short periods of time, sometimes milliseconds. It doesn't affect the types of trades that small traders make. For your trading, is like a C-note to go put the money back or on black? No, it's not. I have a reason. I put on a trade. I have a reason for a trade, and I have a risk management. So it's not like that. It's just that I don't have time to devote to trading, and I recognize that. And there are times where I do trade more seriously, but those are intermittent. And I wouldn't say there might come a time where I'm not doing a lot of other things and I want to trade for a while, and then I'll treat that seriously. But while I'm doing 18 other things, I know better than to trade much. Any other questions? I think we got them, right? So those were a lot of good questions, and I don't know if there's anything else.
No, actually that's all, at least that I can see.
All right.
And a few. There are a few. Okay, I think that's all. Well, thank you a lot, Jack. It was really a pleasure to have you here with us, and we hope to still have you back in the near future. I see some questions now. I see questions here of an attendee that didn't understand the message of the hook.
Say again?
I didn't understand the message of the hook.
The message, of getting off the hook.
Yeah.
That means that if you're very, very worried about a position, say on a Friday, the market, say you're short a market, and the market closes very strong on Friday at new highs with lots of bullish news, and you're short, and you're worried Monday morning, oh my God, market's going to gap way higher, you're going to lose a lot more money. And then Monday or Sunday night, and Sunday night comes and the market's barely up. Maybe it's even down, or maybe it's up only a little, and it doesn't go. A lot of times that means that your position's okay, because if it was really with that much bullish news out, if the market doesn't go more against you, if it lets you get out easily, then maybe you shouldn't get out. That's the point.
I have put one last question there in your chat window, and that will be the last one.
The markets are fractal in nature. Self-similarity is always present. Why do you think these patterns? Well, because we live in a fractal world. Everything in nature, everything is fractal. Whether it's shorelines or tree leaves or tree branches or they're just our physical universe is just fractal in nature. So I guess there's no surprise that the markets would be fractal as well.
Mm-hmm. Okay. Jack, thank you very much again. I will thank you in the name of our attendee tonight.
And thank you to the audience. There were a lot of very smart, insightful questions.
Yeah, tremendous questions. Tremendous questions.
It makes it easy for me too to be able to answer some good questions. So I hope it was useful, and thank you very much.
Yeah, I will be sending tomorrow your presentation. Okay, so
right.
Even though it's only images, but it might bring some ideas back.
That's for internal because these images are not for reproduction.
Yeah, of course, of course.
Right, okay.
Well, thank you a lot again,
okay,
Jack.
Great.
It was a real pleasure to have you here.
Thank you very much.
So have a good night. I think there it's still evening.
Yeah, well, it's early. It's 5 hours
Here
earlier
is
than
it.
you. But,
Yeah, here is 11 p.m. But thank you
Okay.
again.
very
Have a good
much.
day.
Bye.
And we'll be staying here now in Portuguese. Okay, thank you a lot again.
Bye.
Bye bye. Ok, muito obrigado então a todos pela vossa participação no seminário. Espero que tenha sido interessante. Um seminário. Só um pouco. Jack, can you please pass me to be the presenter?
Oh, sorry, I just heard. Yeah, let me find where that is. Can I just close out, or is there a spot for me to? I don't see.
No, go to the staff. Do you see staff there? And do you see extra brokers? Right click and no, wait, I will do that.